I need you to really lock in for this one. I'm not exaggerating when I say today is the first time in months I've seen the market line up in this exact way. I spent the last few hours doing my own digging and not reading headlines, not copy ping Twitter takes. I mean, real due diligence. And what I'm seeing across the CME futures, across the bond market, across crypto Twitter, and even in the reactions from analysts who usually pretend they know everything, that combination hasn't shown up once in this entire cycle. And if you're holding XRP, this setup matters more than you think. Here's the raw truth. For 3, maybe even 4 months straight, the market has been running on this fairy tale expectation that we're getting 2 rate cuts, just 2 little 25 basis point cuts. That's been the core narrative. That's what traders have been pricing in. That's what analysts kept repeating. And honestly, people got comfortable with it. But now, out of nowhere, the data flipped. CME just shifted the odds again. And pause, meaning no rate cut at all, is now leading. And before anyone rolls their eyes and goes, Jason, they flip all the time. Let me remind you, the CME has been frighteningly accurate this entire year. They've been ahead of the curve every single meeting. So let me cut through it. If we walk into the December 9th FOMC and we get a pause instead of a cut, that is not bullish in the short term. I'm not here to lie to you. It's not bullish for Bitcoin. It's not bullish for equities. And it's definitely not short-term bullish for XRP. But, and this is what almost nobody is connecting, QT ending on December 1st is the wild card. That's the piece that changes liquidity conditions under the hood. If you've been wondering, Jason, why the hell is XRP flat? Why is Bitcoin stuck? Why are altcoins acting dead? This is part of the answer, but that's only one side of the story. The other side is what's happening with Bitcoin. And this is where most retail traders are completely missing the plot. Bitcoin has dropped around 30% multiple times this cycle after hitting major highs. It's not random. It's not bear market panic. It's structural. It's exactly how the market resets the board before the next leg. And right now, we're sitting inside that same pattern again. And people on crypto Twitter are losing their minds, declaring a bear market, screaming that the cycle's over, acting like the world is ending. Meanwhile, the chart is doing exactly what it's supposed to do. But here's the uncomfortable truth most people don't want to hear. If Bitcoin doesn't move, altcoins don't get a say. We can talk about XRP utility all day. We can talk about partnerships. We can talk about the bigger narrative. But right now, the only thing that matters is macro pressure. And that pressure is about to intensify once those October FOMC minutes drop next week, because those minutes will confirm exactly where the Fed's mindset truly is. Cuts, pause, QT projections, all of it. And once that hits the market, you're going to see volatility that reminds you of early 2021. I need you to understand this. I'm not rushing this video today. I'm not giving you hype. I'm giving you the full picture. The part the influencers ignore because it's not sexy enough, and the part the traders ignore because they're too busy chasing green candles. December is going to test conviction harder than anything we've seen this year. The combination of QT ending, FOMC uncertainty, Bitcoin structural correction, and XRP's flatlining price is building towards something that most people are completely unprepared for. Now, let's get into the actual meat of what's driving this whole situation, because the headlines aren't telling you the truth. The data is, and the data is getting loud. The CME futures market flipped again, and this time it's not. Subtle. Right now, we're looking at roughly a 55% probability of no cut in December and around a 44% probability of a 25 basis point cut. That's essentially the market telling you we're not expecting a Christmas gift from Powell. And when the market expects nothing, it behaves differently. It tightens up, it gets defensive, it starts preparing for shock instead of opportunity. But here's where it gets even more interesting. When you cross-check the CME numbers with what Polymarket is showing, you see almost the exact same distribution. That's not a coincidence. That's alignment. And whenever traditional futures data and prediction markets line up within a few percentage points, it means traders across the board are all seeing the same storm forming. Half of them think the Fed is done cutting for the year. The other half thinks we barely squeeze one more cut in, but nobody, literally nobody, is pricing in anything more optimistic than that. And you already know what that means. If the Fed actually surprises with a cut, markets rip, because zero expectation equals maximum impact. Now, let me call out something people keep conveniently forgetting. The last 2 cuts didn't move the market at all. You remember that? I was live with you both times. Everybody was hyped. Everybody expected fireworks, and we got nothing. Why? Because the cuts were already priced in. Traders had already positioned. There was no shock factor. But this time, the conditions are different. The market isn't positioned for a December cut. If we get one, it's a blind side. And trust me, markets react violently to blind sides. But the real elephant in the room is QT 10 out of 12 FOMC members support continuing QT. And that's not a small thing. That tells you where their heads are at. They're not trying to pump asset prices. They're trying to preserve control. The only thing we don't know yet is how firmly they're committed to keeping rates elevated into Q1, and this is where the October minutes come in. Those minutes drop in about 5 days, and they're going to expose the truth behind the public press conference Powell gave because, let's be honest, these press conferences are PR. The minutes are where you see the raw thinking, the fears, the disagreements, the internal warnings. And here's what makes this moment so critical. The market is frozen until we get those minutes. Everyone is waiting. Everyone is second-guessing their positions. And this is exactly the kind of environment where you see sharp moves out of nowhere because liquidity dries up while conviction collapses, Bitcoin selling pressure, XRP's flat consolidation, stocks pulling back. All of it is tied to this exact uncertainty. Another thing most people are ignoring is how macro traders are treating this environment. The bond market is acting like the Fed is nowhere near comfortable. Yields are stuck. Investors are rotating into safety. And the dollar is showing these little bursts of strength that tell you one thing. Nobody believes the Fed is done tightening psychologically. Even if the policy tightening is slowing, the narrative tightening hasn't eased at all. And this entire macro setup bleeds directly into crypto, especially XRP, because XRP isn't just a speculative pump and dump asset anymore. It's tied into liquidity expectations, institutional behavior, and broader risk sentiment. If macro freezes, XRP freezes. If macro loosens, XRP outruns everything else. That's the reality. So right now, the core development you need to keep your eyes on is simple. The FOMC minutes, the December pause narratives, QT's influence on liquidity, and the market's complete lack of positioning for a surprise cut. Those four factors are about to collide, and the market is pretending it's just another week. Now, here's where things really start connecting, because if you only look at the rate cuts and pause probabilities, you're missing half the picture. The real leverage in this market right now isn't retail sentiment. It's the institutional positioning, the liquidity flows, and the way Ripple fits into this global shift that nobody outside crypto Twitter is actually paying attention to. So let's break it down the way it actually works in the real world, not the fantasy world people on TikTok like to pretend exists. Ripple's strategy has been painfully consistent for years now, but the difference today is that the landscape around them is finally catching up. You've got BlackRock KK openly pushing tokenization narratives. You've got Fidelity expanding digital asset infrastructure. You've got giants like Swift integrating blockchain-based settlement tests. And while everyone else is screaming about price, Ripple's out here building the plumbing that these institutions are eventually going to rely on. It's not sexy, but it's the reality. And it matters right now because institutions don't care about hype. They care about liquidity, compliance, and efficiency. And XRP sits right in the middle of that triangle. But here's what most people aren't connecting. Institutional players move based on macro clarity. They don't push buttons during chaos. They wait for predictable frameworks, predictable liquidity, and predictable regulatory outcomes. That's why you're not seeing fireworks yet. It's not because XRP is weak. It's because the environment hasn't unlocked the institutional flow Ripple has been preparing for. And trust me, when that switch flips, it's not going to look like a retailed rally. It's going to look like volume showing up in bursts, corridors activating, and settlement rails turning on in places the average trader never even thinks about. Now bring Bitcoin into this. Bitcoin is the lighthouse for institutional sentiment. They use it as the macro risk barometer. So when Bitcoin refuses to move, institutions hesitate on everything else. That's why altcoins, XRP included, have been suffocating for weeks. Not because they're fundamentally dead, but because Bitcoin is doing exactly what a top-heavy asset does during macro indecision. It stalls, shakes out leverage, retraces systematically, and holds liquidity hostage. So let me give you the blunt version. If Bitcoin keeps struggling to lift off, XRP isn't getting a separate life raft. This isn't 2021. Retail isn't driving the bus anymore. Institutionals are, and institutions don't rotate into altcoins while the macro is hanging in the balance. They rotate into altcoins when macro aligns, liquidity is expanding, and regulatory pathways look inevitable, not questionable. And here's the part nobody wants to say out loud. Ripple knows this. That's why they've doubled down on infrastructure. licensing, payment corridors, stablecoin frameworks, and settlement expansion instead of trying to hype the price. They understand that institutional adoption doesn't care about community noise, it cares about readiness. And Ripple is getting ready for a liquidity environment that isn't even here yet. When QT ends, when rate cuts become real instead of hypothetical, when the Fed signals a shift in risk appetite, that's when the institutional pipeline Ripple has quietly built starts becoming a weapon. Now add in the tokenization wave. You've got BlackRock CK saying tokenization is the next trillion-dollar frontier. You've got NASDAQ building digital asset custody. You've got banks onboarding blockchain infrastructure behind the scenes. And what does all of this require? Fast settlement, scalable settlement globally, accessible rails, interoperability. XRP fits that bill better than 99% of the coins people obsess over daily. So when people ask, Jason, why isn't XRP moving? The real answer is simple, because institutional movement hasn't started yet. An institutional movement won't start until macro unlocks, and macro won't unlock until the Fed signals the next phase, which is exactly why the next few weeks are so critical. Because once that alignment happens, XRP isn't following the market, it's leading it. Let's get into the part nobody in mainstream crypto media seems willing to touch: how the rest of the industry is reacting to what Ripple is doing. Because whether people want to admit it or not, you can't ignore the shift anymore. The smartest players in this space and the CEOs, the institutional analysts, the infrastructure builders, they're not laughing at Ripple the way they were in 2018. They're watching closely. And in some cases, they're quietly moving in the same direction. Now, here's the uncomfortable truth for the maxi crowds. Ripple didn't chase hype. They chased legitimacy. And now, the same people who mocked them for working with banks are scrambling to build enterprise solutions because they finally realized where the real money is. You've got Ethereum pushing hard for institutional staking frameworks. You've got Solana trying to position itself as the chain for high-frequency financial apps. You've got Avalanche and Polygon bending over backwards for tokenization pilots. Everyone is sprinting toward the same target, but Ripple was already there a decade ago. What this really means is that we're seeing alignment, not coincidence. Every major institution talking about blockchain, from HSBC to JP Morgan, from BlackRock to Fidelity, is pushing the same three pillars: tokenized assets, instant settlement, and interoperability. And the asset that was literally designed to solve settlement friction is XRP. That's why you're seeing the subtle shift in tone from analysts. They used to treat XRP as a meme, something outdated. Now they're calling it a serious contender and a strategic settlement layer. They're late, but at least they finally got the memo. And look at the regulators. This is where things get real. Europe is already ahead, with my UK is openly pushing digital asset legislation that favors institutional frameworks. Singapore and the UAE are basically throwing the doors open to blockchain settlement systems. And the United States, slow as they are, is getting boxed in by everyone else's progress. Once regulation catches up, the institutions sitting on the sidelines will move instantly. They don't care about narratives, they care about compliance and liquidity, and Ripple is one of the only companies in crypto building for that world. Now, compare that with Solana and Ethereum. Don't get me wrong, solid tech, both of them, but they serve different purposes. Solana is speed-focused, but constantly fights reliability concerns. Ethereum has the ecosystem, but struggles with cost and congestion. Ripple isn't trying to be a smart contract playground or a token launch factory. They're building rails that institutions can actually use. And the market is starting to realize you don't need 10,000 meme coins. You need a handful of assets that actually move value. Let's talk ETFs for a second, because this is a huge one. Everyone's celebrating Bitcoin and Ethereum ETFs. But here's the reality. Those ETFs open the door. They normalize the idea of regulated crypto exposure. And once that door is open, institutions are going to ask one very simple question: what's the asset that solves real-world financial problems? XRP becomes the obvious answer. Bitcoin is digital gold. Ethereum is the smart contract layer. XRP is the settlement engine. That's diversification at an institutional level, and the reactions are already telling you where this is heading. Analysts calling tokenization a 1,630 trillion opportunity, banks saying blockchain will fundamentally reshape settlement, payment giants evaluating stablecoins and digital settlement tech. The entire financial world is warming up to crypto, but they're warming up to the parts that actually work in the real world. Ripple's ecosystem fits that mold more cleanly than anything else. Guys, think about the broader implications here. When institutions adopt blockchain at scale, they're not going to pick assets based on hype. influencers, or memes. They're going to pick the tools that integrate seamlessly, settle instantly, and reduce cost. That's the zone where XRP lives. And as more institutions get public about it, you're going to see a shift in narrative that completely blindsides retail investors who only look at price charts. This is the turning point, the moment where crypto moves from speculation into infrastructure, and the reactions across the industry tell you exactly who's ready for that transition and who's not. All right, guys, let's wrap this up with the part most creators shy away from, the brutally honest conclusion. Because if you've been paying attention to everything happening right now, the message is pretty clear. We're standing at a crossroads. On one side, you've got the uncertainty, the volatility, the FOMC drama, the geopolitical mess, the regulatory limbo, everything that makes crypto feel like chaos. And on the other side, you've got undeniable progress, institutional alignment, and a global financial system quietly shifting toward digital settlement. XRP sits right in the middle of this collision. Let me be straight with you. Anyone expecting a clean, predictable ride from here is living in fantasyland. Volatility is not going away. The next few weeks could easily break weaker investors. And yes, even though the macro shifts look promising long term, the short term is loaded with traps. If the FOMC pauses instead of cuts, markets might stall. If liquidity dries up temporarily, altcoins will bleed harder than Bitcoin. If Bitcoin drops to the mid 80s, XRP will catch that impact. This isn't fear, it's just math. People love pretending they're early visionaries, but panic every time the chart turns red. That's the contradiction. If you believe in the long-term thesis, then correction shouldn't shock you. And if you don't believe in the fundamentals, then you shouldn't be holding the asset in the first place. That's the line you need to draw, because this next chapter is not for the indecisive. The truth is, XRP is positioned better than most assets for where the financial world is heading, but that doesn't make it magic. It doesn't move independently. It still reacts to macro pressure, still follows Bitcoin dominance, still gets hit when liquidity vanishes. This is why you need to think like an adult investor, not a gambler. If BTC does break down into that 85-86K zone, altcoins will feel it hard. That's not the end of the story, but it is the reality you need to prepare for. At the same time, you cannot ignore what's building behind the scenes. The end of QT, global regulatory clarity, tokenization pilots, real-world settlement use cases, institutional interest, and the fact that even the biggest critics are starting to shift their tone. These are signals you don't get in bear markets. These are signals of construction. You don't need opium to see that the pieces are lining up, but you also don't need delusion to recognize it won't move in a straight line. Now, before we close this out, let me hit you with the part that too many creators sugarcoat. The risk. Every single thing I've said today is analysis, probability, and informed projection, not certainty, not fate, not guaranteed outcomes. You're dealing with markets that can flip in minutes and governments that can change policy overnight. XRP, like every crypto asset, carries risk: market risk, regulatory risk, liquidity risk, macroeconomic risk. Pretending otherwise is irresponsible. If you're putting money into this space, you need to be ready mentally and financially for volatility and the possibility of being wrong. And because I'm not here to babysit anyone, let me put this clearly. None of this is financial advice. I'm not your financial advisor, your accountant, or your portfolio manager. I'm just breaking down the information, calling it how I see it, and pushing you to think critically instead of blindly following hype. You make your own decisions, you carry your own gains and your own losses. And that's how this game works. If you can accept that, if you can operate with clear eyes instead of emotion, then you're already ahead of 90% of this space, because the next phase of crypto is going to reward people who understand fundamentals, think long-term, and don't crack under pressure. The ones who expect overnight rockets are going to get wiped again. So that's where we stand. A lot of noise, a lot of uncertainty, a lot of opportunity. It's messy, it's unpredictable, and it's absolutely critical to stay grounded. You've got the breakdown, you've got the probabilities, you've got the risks.